Let me ask you something simple. When you paid for groceries this week, did you pause for a second? Not because you forgot your card, not because you bought extra, but because the total just felt off. You stood there looking at the screen. Same milk, same bread, same eggs. Yet the number looked heavier, like your money lost weight overnight. That tight feeling in your chest is not your imagination. Many people are being told that price growth is cooling, that things are improving, that the worst is behind us. But here's the quiet truth. Even if prices are rising more slowly now, they are rising on top of what already happened. And what already happened was big. Over the last few years, prices jumped fast. Food, rent, insurance, cars, doctor visits, school supplies, almost everything. And when prices jump, they rarely jump back down. They just build a new floor. That means the slow rise you hear about today is sitting on top of a steep climb from yesterday. So when someone says inflation is only a few percent now, that number is measured from a level that is already much higher than it used to be. That is why your paycheck feels smaller, even if the news sounds calm. And something else is happening right now. Many companies held back from raising prices again last year. They absorbed higher costs quietly. They waited. But according to business surveys and public reports, that waiting period is ending. Companies are starting to push those costs forward to you. This is not loud. It does not come with sirens. It shows up slowly. A few dollars more on your monthly bill, a higher renewal notice, a restaurant meal that costs more but looks the same. You feel it, even if no one makes a big speech about it. And this matters because the system behind it is larger than one store or one company. This is about how money moves through an economy. Here's the simple version. For many years, government spent more than they collected in taxes. To cover the gap, they borrowed a lot. Central banks helped by creating money and buying that debt. That kept interest rates low and made borrowing easier. When more money is created faster than goods are produced, prices rise, not in theory, in practice. At first, it does not look dangerous. Jobs grow, markets rise, homes go up in value. People feel richer on paper. But the extra money does not disappear. It moves, and eventually it shows up in everyday prices. We saw that first wave a few years ago when price growth jumped fast. That was the shock. Everyone noticed. Now we are in a different phase. The fast spike slowed down, but the higher price level stayed. And now, as businesses face new costs from wages, supply chains, trade rules, and debt payments, they are adjusting again. This is not a repeat of 2008. Back then, the main problem was collapsing banks and falling home prices. Today, the system is stressed in a different way. The pressure is not a crash, it is a squeeze, a slow grind on household budgets. If you rent, you feel it. If you own a home with a mortgage, you feel it. If you carry credit card balances, you feel it even more. Interest rates are higher than they were for years. That means borrowing costs more. Monthly payments eat more of your income. And here is the part that worries many families. Wages may rise, but essential costs often rise faster. Lower income households spend a bigger share of their money on basics, food, housing, energy, healthcare, transportation. When those categories move up, there is no easy substitute. You cannot skip rent. You cannot ignore car repairs if you need your car to work. You cannot delay medicine. That is why so many people say the economy feels weak, even when official numbers sound stable. Because the official numbers are averages. Your life is not an average, it is personal. And when you add it up, you may see that your own cost of living rose much more than the headline rate suggests. That gap between the official story and your daily experience creates confusion. But it should not. It makes sense once you understand the system. The system expanded fast. Money was created fast. Debt grew fast. Prices adjusted fast. Then the speed slowed, but the level stayed high. And now businesses are beginning to protect their profits again by raising prices where they can. That creates a second wave, not a shock wave, a pressure wave. You may not see it all at once, you will feel it month by month. A small rise in your insurance, a higher grocery total, a bigger utility bill. Nothing dramatic alone, but together they reshape your budget. And here is the calm but serious part. Prices that have already risen are unlikely to return to old levels. History shows this again and again. After big jumps, prices usually settle at a new, higher floor. They stop rising as fast, but they do not roll back to where they were. That means the real challenge is not waiting for things to go back. It is adjusting to where things are. And that requires seeing clearly. Right now, the global system is carrying heavy debt. Governments, companies, households. When debt is high, the system becomes sensitive. Higher rates strain budgets. Lower rates risk new price growth. Policy choices become harder. And in that tight space, everyday families carry the weight. You are not crazy for feeling pressure. You are living inside a system that stretched too far and is now trying to rebalance without breaking. The question is not whether the pressure is real. It is how long it lasts. And what it means for your savings, your job, and your future plans. Because once you see the pattern, The confusion at the checkout counter starts to make sense. And when things make sense, you can respond calmly instead of reacting in fear. This is not about panic. It is about clarity, and clarity is power. Now let's go a little deeper. Think about how a price actually changes. A company pays more for raw materials. It pays more to ship goods. It pays higher wages. It pays more interest on its loans. At first, it may try to absorb those costs. It cuts somewhere else. It accepts lower profit for a while, but that cannot last forever. At some point, it adjusts the price tag. That adjustment is what many households are starting to see again. Reports from business groups show many companies planning new price increases to protect their margins. Not because they want to punish customers, because their own costs moved up. This is how pressure flows through a system. It starts in the background. It ends at your wallet. And this is why the current moment feels different from the early spike a few years ago. Back then, prices jumped fast and loud. Now the increases are quieter, more selective, spread across categories. But they are landing on top of a base that is already much higher than before. Let's talk about food for a minute. Food prices rarely fall in a lasting way. They may move down for a month or two, but over long periods, they trend upward. Weather problems, smaller livestock herds, higher fuel costs, global supply shifts, all of these can keep food prices elevated. And when food costs rise, every household feels it, because everyone eats. If you were spending a certain amount each month a few years ago, you may now be spending hundreds more for the same basket. That difference does not disappear. It crowds out savings. It reduces what you can invest. It shrinks your cushion. Healthcare is another area under steady pressure. Insurance premiums, doctor visits, prescription costs. These tend to rise faster than general prices over long periods. If support programs change or expire, families feel that shift quickly, and healthcare is not optional. Transportation is similar. Cars are expensive. Repairs are expensive. Insurance has risen sharply in many places. Parts cost more. Labor costs more. If you rely on a car to work, you cannot simply opt out. All of these categories share one thing. They are essential. When essential costs rise faster than income, stress builds. You might cut streaming services. You might cancel a gym membership. You might delay a vacation, but you cannot cut rent in half or skip groceries. That is why surveys show many working people saying they feel behind, even if they are employed. It is not laziness. It is math. Here is where the larger system matters again. When governments run large deficits for many years, they issue debt. Investors buy that debt. Central banks may also buy it. If investors begin to demand higher returns to hold that debt, interest rates rise. Higher rates ripple outward. Mortgages cost more. Car loans cost more. Credit cards cost more. Business loans cost more. When businesses pay more to borrow, they factor that into their prices. So debt in Washington can eventually shape prices in your neighborhood. That connection is rarely explained clearly, but it is real. And here is something important to understand. This moment is not identical to the financial crisis years ago. Back then, the system froze because credit collapsed. Today, credit is expensive, not frozen. The stress is different. It is slower. It is like a tightening belt rather than a sudden fall. Some people ask, if inflation slowed, why do I still feel squeezed? Because slowing growth in prices does not erase past growth. If something jumps 20% and then rises 3% more, it is still far above where it started. The slowdown just means the climb is less steep. Not that you went back down the hill. And here's a question worth asking yourself quietly. Do you feel like your personal cost of living rose only a small amount recently? Or does it feel much larger? Your answer matters more than any headline. In fact, I would like to know what you're seeing. Have your monthly essentials gone up noticeably this year? Or do they feel stable to you? Your experience tells a story that averages cannot. Now let's talk about the chain reaction. When households spend more on basics, they spend less on extras. That affects small businesses. When small businesses see weaker demand, they slow hiring. When hiring slows, wage growth cools. When wage growth cools but essentials stay high, pressure deepens. This is how a system can slow without crashing. A gradual cooling, a quiet strain. If it continues, it can shape the job market. Companies with strong pricing power, meaning they can raise prices without losing many customers, may stay stable. Companies without that power may struggle. Investors watch this closely. Markets can swing between hope and worry. Bond markets react to debt levels and interest rate expectations. Stock markets react to earnings and growth. But for most people, the daily question is simpler. Will my income keep up with my expenses? That is the real measure of economic health at the kitchen table. And here is where we need balance. There are benefits in this environment for some groups. Savers can earn more interest on cash than they could a few years ago. Workers in high-demand fields may see stronger wage growth. People who own certain assets may see them hold value better than cash. But there are risks. If inflation stays above wage growth for too long, purchasing power erodes. If debt payments eat a larger share of income, flexibility disappears. If governments continue borrowing heavily, long-term pressure on rates can persist. This is not about predicting disaster. It is about recognizing tension. The global system is carrying trillions in debt. Demographics are shifting. Many countries have aging populations. Energy systems are changing. Trade relationships are adjusting. All of these forces interact. When many large systems shift at once, prices and growth rarely move in a straight line. You may feel uncertainty. That is natural. But uncertainty does not mean chaos. It means the system is adjusting, and adjustment periods require awareness. Right now, the key signals are not dramatic headlines. They are small shifts. Business surveys showing planned price increases, debt levels staying elevated, interest rates remaining higher than the ultra-low era, consumer surveys showing persistent strain. Individually, each signal looks manageable. Together, they form a pattern of a system working through excess. And working through excess takes time. The question is not whether you can control global debt or central bank policy. You cannot. The question is how you respond within your own household. Because while the system moves slowly, your budget moves monthly, and small monthly gaps compound. Understanding this is not meant to scare you, it is meant to steady you. When you see the mechanism clearly, you're less likely to be misled by simple slogans. You stop waiting for a quick fix. You start planning for a different baseline, and that shift in mindset can be powerful. Let's step back and look at the bigger pattern. History shows something simple. When a country builds up large debt over many years, it faces a hard choice. Either it slows spending and accepts pain, or it keeps borrowing and risks more pressure on its currency and prices. There is no easy path. And the United States is not alone. Many Western nations are in the same position. Debt levels are high compared to the size of their economies. That means a large share of tax money goes toward interest payments. When interest rates rise, those payments grow. That leaves less room for other spending. So governments may borrow more to fill the gap. And the cycle continues. This does not explode overnight. It stretches. It strains. It slowly reshapes priorities. You might notice more talk about budget fights. You might hear warnings about deficits. You might see debates about taxes and spending. These are not random arguments. They are symptoms of a system under pressure. And here is why this moment is not the same as the financial crisis years ago. Back then, the problem was hidden risk inside banks and housing. When it cracked fast. Today, the stress is more visible. It sits in government balance sheets. It sits in long-term promises. It sits in the cost of maintaining large systems. That makes it slower, but also more persistent. Think of it like this. In 2008, the storm hit suddenly. Today, the tide is rising gradually. You may not notice each inch, but over time, the shoreline changes. And that is what many families are sensing. They feel like they are working just as hard. Yet saving feels harder. Retirement targets feel further away. Emergency funds drain faster. That quiet worry is not irrational. It reflects real changes in cost structures and income growth. Now let's talk about markets and money in simple terms. When inflation rises, cash loses purchasing power. That means the dollar is sitting still by less over time. When interest rates rise, bonds can lose value in the short term. But new bonds may pay higher yields. Stocks react to both growth and rates. Higher rates can pressure company profits, especially for businesses that rely on borrowing. Housing reacts strongly to mortgage rates. When rates climb, monthly payments rise and affordability falls. None of this guarantees one outcome. It simply shows how connected everything is. If you are saving for retirement, this matters. If you are just starting your career, this matters. If you are nearing retirement, this matters even more, because long periods of higher living costs can change how long savings last. But here is an important emotional shift. Periods like this are not new in history. They feel new when you're living through them. But many generations have faced similar adjustments. The key difference is how people respond. Some wait for the old normal to return. Others accept that the baseline has shifted and adjust early. That adjustment does not require panic. It requires honesty. Ask yourself a few calm questions. Have I rebuilt my monthly budget based on current prices, not old memories? Am I carrying high-interest debt that grows faster than my income? Is too much of my savings sitting idle while costs rise? These are not dramatic questions. They are practical. And small changes can create breathing room. For example, reviewing recurring expenses once a year can reveal silent increases. Insurance renewals, subscriptions, service fees, many rise quietly. Reducing high-interest debt can free future income from interest payments. Building a cushion, even slowly, can reduce stress during unexpected costs. For those investing, understanding inflation risk matters. Historically, assets tied to real goods and services have held value better than idle cash during inflationary periods. That does not mean risk disappears. Every asset has risk. But awareness allows you to balance exposure, and balance is key in uncertain times. Now let's return to the system for a moment. If price pressures continue modestly, central banks may keep rates higher for longer. If growth slows too much, they may face pressure to lower rates. Lowering rates can ease borrowing costs, but if done too soon, it may reignite price growth. This is the narrow path policymakers walk. It is not easy, and policy mistakes can have long shadows. That is why watching quiet signals matters more than watching headlines. Look at wage growth compared to essential costs. Look at government deficit trends. Look at long-term interest rates. Look at consumer confidence. These tell a deeper story than one monthly number, and here is a calm truth. The system may not collapse. It may simply grind forward with higher costs and slower growth. That can feel exhausting, but it is manageable with planning. Fear comes from surprise. Understanding reduces surprise. Right now, the surprise phase is over. We know prices jumped. We know debt is high. We know rates rose. The next phase is adjustment. Households that accept the new floor and plan around it are less likely to feel constant shock. You do not need perfect predictions. You need flexible planning. That means keeping options open, keeping skills sharp in the job market, avoiding overextending on debt, staying aware of changing costs. These are simple ideas, but in a stretched system, simple discipline goes far. You may still feel concern. That is natural. But concern can turn into clarity. Clarity can turn into calm action, and calm action is powerful. The global system is shifting. It is not shouting. It is signaling. The question is whether we pay attention early or late. Now, let's bring this home. You cannot control global debt. You cannot control central bank policy. You cannot control trade tensions or government budgets. But you can control how you prepare for a world where prices have reset higher and may keep drifting up. The first step is mental. Stop expecting a return to the old price levels. That hope quietly damages planning. If groceries, insurance, and housing jumped over the last few years, build your future plans around today's numbers, not yesterday's. This removes false expectations. And it reduces frustration, because you stop waiting for something that history shows rarely happens. The second step is clarity in your own math. Many households still budget loosely. They know money feels tight, but they do not track exactly where it goes. In a stable world, that might be fine. In a stretched system, precision matters. When essential costs take a bigger share of income, small leaks matter more. A forgotten subscription, a renewal that jumped 15%, a credit card balance growing quietly at high interest. Individually, these look small. Over a year, they compound. The third step is debt awareness. High interest debt in an environment like this can feel like quicksand. When rates were near zero, carrying balances was less painful. Now, interest charges are real and heavy. Reducing that burden creates flexibility. Flexibility is safety. The fourth step is thinking about purchasing power. Inflation is not just about rising prices. It is about what your savings can buy in the future. If cash earns less than the rate at which costs rise, purchasing power shrinks. Historically, people have looked for ways to hold value in assets tied to real demand. Businesses, property resources, productive systems. That does not remove risk, but it recognizes a basic rule. Over long periods, idle money tends to lose ground in inflationary phases. Again, this is not about chasing trends. It is about understanding forces. The fifth step is career resilience. In slow growth environments, job markets can cool gradually. Hiring may slow before layoffs rise. Raises may shrink before jobs disappear. Strengthening your skills, building networks, staying adaptable. These matter more when growth is uneven. Income stability is your strongest shield. Now let's zoom out one final time. Why does this moment feel heavy to so many people? Because we are transitioning from an era of ultra-cheap money to an era of more expensive money. For years, borrowing was easy. That supported asset prices. It supported spending. It supported rapid expansion. But cheap money can also encourage excess. When the cost of money rises again, excess gets exposed. Weak businesses struggle. Over-leveraged households feel strained. Governments face harder budget math. This transition is rarely smooth, but it is also not automatically catastrophic. It can result in slower, steadier growth. It can result in repricing of assets. It can result in slower, steadier growth. It can result in repricing of assets. It can result in a long period where discipline matters more than momentum. That is where we seem to be. And this is why the gap between headlines and lived experience feels wide. Headlines focus on monthly changes. Your life reflects multi-year shifts. Headlines celebrate when price growth slows. Your budget reflects the full jump that already happened. That difference creates frustration. But once you understand the mechanism, the frustration turns into awareness. Awareness leads to calmer decisions. Instead of asking, when will things go back? You ask, how do I operate well in this environment? That is a stronger question, because it assumes reality, not nostalgia. Let's be honest about risk. If governments continue borrowing heavily while growth slows, pressure on the system can increase. If central banks ease too quickly, price growth could reaccelerate. If they stay tight too long, unemployment could rise. These are real trade-offs. There is no painless solution. But here is the reassuring truth. The Western financial system is large and adaptable. It has weathered wars, oil shocks, recessions, and crises. It adjusts. The danger is not sudden collapse. The danger is slow erosion if people ignore the shift. Slow erosion of savings, slow erosion of purchasing power, slow erosion of confidence. You protect yourself not by panicking, but by staying engaged, watching the quiet signals, understanding debt trends, tracking your real cost of living, maintaining flexibility, and remembering that systems move in cycles. We had a long stretch of easy money and low rates. Now we are in a different stretch. Neither lasts forever. The key is not predicting the exact turning point. It is surviving and even stabilizing during the stretch we are in. You felt something was off at the checkout counter. That instinct was not foolish. It was your brain recognizing a structural shift. The global debt system expanded fast. Prices adjusted upward. Rates rose. Now the system is digesting that expansion. Digesting can be uncomfortable, but discomfort with understanding is better than comfort built on illusion. So take a breath. Look at your numbers honestly. Strengthen what you can control. And accept that the baseline has changed. Because once you accept the new floor, you stop being surprised by it. And when you are no longer surprised, you're no longer powerless. The system is under pressure. Not breaking, not booming, adjusting. And now, so can you.